What's driving this? Is this all the story of this world economy coming back, or is there more to it than that? Perhaps also quite a lot of speculation as people look at other asset classes and think they look way too expensive.
There is a bit more to it than just the global economy coming back. That's an important piece of the puzzle. We know that certainly animal protein demand is heavily tied to income growth. So the rebound in the global economy is definitely a positive driver. But at the same time, you've got the factor of China rebuilding its hog herd after major losses, particularly was very bad in 2019 because of African swine fever. They rebuilt that hog herd significantly in 2020. But then had another round of spreads of that ASF this past winter. So that was a setback. So that's another major driver of increased feed grain demand as well. The other factor is on the supply side. We definitely have seen some weather shocks, particularly in Brazil, which is a major exporter. We see ongoing dry conditions in the U.S., the other major supplier. So those things are putting pressure on the supply side. So you've got this perfect storm of robust global demand, along with weather-related supply disruptions. And of course, you mentioned the less fundamental factors, and that is that you've got traders out there trying to they're long, trying to hedge inflationary risks.
Roland, we'll come to inflation. I want to just get to the question we're really asking you there as well. Why is rice being left behind?
So rice is a bit different because unlike things like feed corn and soybeans, it is so important for direct human consumption. So that's for that reason, we still have very ample stocks of rice globally. In fact, if you look at the last 14 years, right, this current year for a marketing year for rice is the first year in 14 where we're actually expecting ending global rice stocks to come down for the first time. So we've had this major buildup year after year of rice stocks because of its importance for human consumption. And that expected decline in ending stocks this year is very, very marginal. So that's the big difference. When you look at the feed grains, stocks are extremely tight. When you look at global rice stocks, yes, they're going to come down marginally, but still stocks are pretty robust.
Roland, I want to touch on corn at 8-year highs, more than $7 a bushel. I mean, partly to do with Brazil, partly to do with China. Question really is, at what price will farmers start looking for alternatives?
Well, there are reports that livestock feeders are already looking for alternatives. A lot of those reports have come out of China. We actually think that maybe that those reports are a little overdone. When I think about the demand in China, and I think about the modernization that they've made in livestock feeding, and I'm going to include the dairy industry over there. Along with that modernization comes, the need to feed the best types of rations to this livestock to maximize gains. And while there's been reports of more rice and wheat being added to rations, which I'm sure some of that's true, they're still going to be looking at feeding the highest quality rations in things like corn, soybeans.
We talk about insatiable appetite. How about demand destruction? We still have the likes of Brazil and India struggling to contain the virus. In fact, we're seeing a resurgence. How much is that playing into the commodity space? How much could that weigh on demand?
No, absolutely. You're right. We've already seen indications that we're moving up that demand curve, and there's been reports of some pushback at these higher prices. Absolutely. So you've got these kind of offsetting factors globally. You've got a major shift out in demand, which is driving things. That's the driver's seat. At the same time, in some markets, you are starting to see some indications that consumers are pushing back, particularly, again, when I think about China and animal protein demand. That demand curve tends to be much more elastic than it is in, say, the U.S. market. So absolutely, consumers will pull back on purchases, and we've already seen indications of that.
So when will China's demand then weigh on commodities? I mean, when will China say, we have enough? Look into the crystal ball, give us a gauge.
Yeah, sure. No, we think that this robust Chinese demand for feed grains is going to remain in place for at least 2 to 3 years. And whether that ends up being 3 or 4 years is really going to depend on how the global grain crops shake out in 2021. We're early in the season, right? We're in the middle of planting over here in the United States, so we've got a long way to go. I think the June acreage report has the potential to be a major market mover in that. If global grain production is extremely robust this year, I think that will create a bit of downward pricing pressure in the agri-commodity space. But in terms of, to your direct question, that robust Chinese demand, we think it's got to continue for at least 2 to 3 years. To put it in perspective, go back 5 years, the stocks to use ratio in China for corn was at about 99%. Now roll forward to today, it's only about 36%.
Roland, very quickly, I don't want to get too Malthusian about this, but is it also the case that we're going to have high agricultural prices for longer, given that the world population is where it is? Very, very quickly.
For me, it's more about rising incomes in developing countries as much as it is about population growth. But from that perspective, the answer is yes.